Pause for a moment, because this is not a headline. This is a countdown. 90 days. That is the window the global banking system has been given to solve a problem that mathematics says cannot be solved. No bailout language, no gradual adjustment, just a deadline and consequences. Behind closed doors, balance sheets are being rerun. Risk models are failing. And a market most people never watch, silver, has suddenly become a fault line in the global financial system. The question is not if something breaks. The question is where and who is still standing when it does. Welcome to Boring Currency Ledger. If you believe financial history matters more than financial headlines, if you still value careful thinking over noise, then consider subscribing. Not in a hurry, just thoughtfully, like someone who has seen a few cycles and knows preparation beats regret. And before we begin, tell us, from where in the world are you watching today? The story begins with a deadline, not a crisis. That is what makes it dangerous. For decades, the global financial system survived not because it was stable, but because it was flexible. When pressure appeared, time was extended. Rules were adjusted, positions were rolled forward, losses were delayed. The system learned to survive by never forcing a final answer. This time was different. A single executive order introduced something the modern financial world fears more than volatility: a fixed clock. 90 days, not a guideline, not a suggestion, a requirement. From the outside, the order appeared technical. It spoke in regulatory language, audits, disclosures, and compliance. To most observers, it looked like another policy document that would be debated, delayed, or diluted. Inside financial institutions, however, it was immediately understood for what it was: a structural ultimatum. The order did not target prices, it did not target speculation, it targeted alignment. It demanded that financial promises be backed by physical reality. That demand alone was enough to create panic. Modern finance is built on abstraction. Contracts represent assets. Paper represents ownership. Risk is distributed through derivatives, swaps, and futures. In normal times, this works because not everyone asks for delivery at the same time. Trust fills the gap between what exists and what is promised. This order questioned that trust. By setting a 90-day deadline, the system was forced to confront a problem it usually avoids: whether the assets backing the contracts actually exist in accessible form. The order required institutions to prove, not claim, that they could meet their obligations. The focus on silver was not accidental. Silver sits at the intersection of finance and industry. It is traded like a financial asset, but consumed like a raw material. Unlike gold, it is not simply stored. Unlike oil, it cannot be easily substituted. It is essential, practical, and finite. That combination makes silver uniquely dangerous when deadlines appear. Banks had long treated silver exposure as manageable. Positions were hedged, offset, or rolled. Price movements were absorbed through leverage and liquidity. As long as time remained flexible, exposure remained theoretical. The order removed that flexibility. 90 days meant positions had to be resolved, not managed. Promises had to be matched with metal. Accounting assumptions had to face physical limits. The system was no longer being asked what silver was worth, but whether it could be delivered. This distinction matters. Price can adjust gradually, delivery cannot. Inside large financial institutions, risk teams began running scenarios that had rarely been taken seriously. What happens if delivery is demanded? What happens if inventories cannot be accessed? What happens if counterparties refuse to sell at any reasonable price? These questions exposed a truth rarely discussed in public. Much of modern finance assumes cooperation. It assumes sellers will appear. It assumes markets will remain orderly. It assumes confidence will hold. Deadlines remove those assumptions. The 90-day window also disrupted political expectations. Markets are accustomed to long transitions. Policy usually arrives with warning, negotiation, and gradual implementation. This order offered none of that. It compressed years of adjustment into weeks. That compression is what made it powerful. The business community often focuses on earnings, rates, and growth. But structural events operate differently. They do not announce themselves through profits or losses. They reveal themselves through stress, silence, and sudden rule changes. The lack of immediate public discussion was not a sign of irrelevance. It was a sign of uncertainty. Institutions needed time to understand the full implications before speaking. Markets needed time to interpret what could not be easily modeled. For entrepreneurs and business leaders, this moment mattered not because of silver itself, but because of what it represented. It signaled a shift away from trust-based systems toward verification-based systems. It signaled that promises might soon require proof. History shows that major financial shifts rarely begin with crashes. They begin with policy changes that seem narrow and technical. Only later do their consequences become obvious. This order did not break the system, it challenged it. And challenges reveal weaknesses long before collapse occurs. As the 90-day clock began, the question was no longer whether the system was efficient or profitable. The question became whether it was honest, whether claims matched reality, whether time could still be used as a shield. The story pauses here at the moment the clock starts ticking. The announcement has been made, the deadline is set. The system is not yet broken, but it has been forced to answer a question it has avoided for decades. And in finance, unanswered questions are often more dangerous than known problems. The danger was never visible on the surface. That is why it grew so large. For years, silver appeared calm. Prices moved within ranges. Volatility came and went. To most businesses, it was a background commodity, important for manufacturing, but irrelevant to finance. Inside the banking system, however, silver had become something else entirely. It had become a tool. Banks did not treat silver primarily as metal. They treated it as a contract, a number on a screen, a position that could be adjusted, hedged, or rolled forward. The physical metal mattered far less than the paper claims tied to it. This is how paper silver quietly multiplied. A single ounce of silver could support many promises. Futures contracts, options, swaps, structured products. Each one created exposure without requiring delivery. As long as contracts were settled in cash or rolled over, no problem appeared. The system rewarded this behavior. It generated fees, liquidity, and control over price movement. From a balance sheet perspective, it looked efficient. The risk was hidden in timing. Banks assumed that most counterparties would never ask for metal. They assumed that industrial users would source supply quietly. They assumed that price signals would prevent sudden shortages. These assumptions were not written down, but they were embedded in every model. The 90-day ultimatum shattered those assumptions. Suddenly, exposure was no longer theoretical. Disclosure meant transparency. Transparency meant comparison. And comparison meant that institutions could see how crowded the short side had become. A short position is not dangerous by itself. It becomes dangerous when it cannot be closed. In silver, closing means buying metal or contracts from someone willing to sell. That willingness disappears when scarcity becomes visible. Banks realized they were not isolated. Many of the largest institutions were positioned in similar ways. Each one assumed the others would provide liquidity. Each one assumed time would remain flexible. Deadlines destroy that logic. The real problem was not the size of individual positions. It was correlation. When many institutions attempt to reduce exposure at the same time, prices do not adjust smoothly. They jump, liquidity vanishes, markets freeze. This is not theory, it is history. The structure of the silver market made this worse. Unlike equities or bonds, silver inventory is not centrally controlled. It is dispersed across vaults, manufacturers, investors, and governments. Ownership is fragmented. Access is limited. Banks do not own most of the silver tied to their contracts. They rely on availability. The distinction between eligible and deliverable inventory became critical. Eligible silver meets specifications. Deliverable silver is actually for sale. Banks had long treated these categories as interchangeable. The ultimatum forced them to separate fantasy from fact. Internal reviews began revealing uncomfortable truths. Much of the silver counted in risk models was not accessible at any reasonable price. Some was tied up in long-term industrial use. Some was held by entities with no interest in selling. Some existed only as accounting entries. Paper exposure had outgrown physical reality. What made the situation more fragile was leverage. Derivatives allow large exposure with small capital. This magnifies returns in calm markets. It also magnifies losses when assumptions fail. As banks attempted to reduce risk, they faced a paradox. Selling contracts required buyers, buying metal required sellers. Both sides became cautious at the same time. This is how liquidity disappears. For the business community, this matters because banks are not isolated actors. They are central nodes. When they adjust risk, credit conditions change. Lines tighten, terms shift, confidence weakens. Silver exposure was not a side issue. It was connected to funding, collateral, and counterparty trust. A problem in one corner of the balance sheet threatened others. Executives understood this quickly. The concern was not public losses. It was internal instability. Risk committees could not agree on exit strategies because exits required cooperation from a market that no longer behaved predictably. The ultimatum turned optional exposure into mandatory resolution. That is the core difference. In normal markets, banks choose when to act. Here, they were told when action must be completed. The clock did not care about market conditions, price impact, or reputational risk. This is why silence followed the announcement. Not because nothing was happening, but because too much was happening at once. Part 2 ends with recognition. The banking system realized it was not managing a market position. It was managing a structural imbalance created over many years. Paper silver had worked as long as time could stretch. Time had stopped stretching. And once time becomes fixed, leverage becomes dangerous. In the next part, the focus shifts away from banks and toward the physical world, where silver exists not as contracts, but as metal, machinery, and supply limits that do not respond to financial models. The problem moved from screens to warehouses. That is where it became unsolvable. Financial systems can adjust numbers quickly. Physical systems cannot. Silver belongs to the physical world, governed by geology, engineering, and time. When pressure shifted from contracts to delivery, the limits of reality appeared. Silver does not sit idle waiting for buyers. Most of it already has a job. A large share of above-ground silver is locked inside factories, electronics, medical tools, vehicles, and energy systems. Once silver enters industrial use, it does not circulate back into markets easily. Recycling takes time. Extraction takes years. Inventories cannot be expanded on demand. This is where financial logic fails. Banks assumed that higher prices would unlock supply. That assumption works for assets held purely for investment. Silver is different. Much of it is held because it is needed, not because it is optional. Manufacturers do not treat silver as inventory to trade. They treat it as input to protect. Production lines depend on it. Contracts depend on it. Missing supply means missed deliveries, penalties, and lost market share. When prices rise sharply, industrial users do not sell, they secure supply. This behavior creates a feedback loop. Scarcity increases urgency. Urgency increases hoarding. Hoarding reduces availability. Availability disappears faster than price can adjust. Mining does not solve this problem in the short term. New silver does not appear because prices rise. Mines take years to develop. Existing mines cannot suddenly double output. Environmental permits, labor constraints, and energy costs limit flexibility. Recycling also has limits. Most silver is used in small quantities spread across millions of devices. Recovery is slow and inefficient. It cannot respond to a 90-day deadline. This is why supply curves drawn in financial models are misleading. They assume responsiveness. Silver supply is rigid. Inventory classifications add another layer of confusion. On paper, large quantities of silver appear available. In reality, much of that silver is owned by entities that have no incentive to sell. Ownership matters more than location. A bar in a vault is not the same as a bar for sale. As banks attempted to identify sources of supply, they encountered resistance. Holders understood the situation. They knew urgency had shifted. They knew sellers were no longer competing with each other, but with time. Time favors the holder. Retail investors, industrial firms, and governments all behave differently when scarcity becomes visible. Instead of asking what price silver can reach, they ask what silver might be worth later. That change in thinking removes supply from the market. This is why price signals alone cannot clear the market quickly. Prices rise, but sellers wait. Each delay tightens conditions further. The mismatch becomes obvious when demand is counted honestly. Industrial consumption does not pause for financial stress. Factories do not shut down because banks need metal. Energy transitions do not slow because contracts must be settled. Silver demand is continuous. The 90-day window forced two groups into competition: institutions that needed silver to close financial positions and industries that needed silver to operate. One group could walk away from contracts. The other could not walk away from production. Markets favor necessity. As availability shrank, the idea of finding silver became unrealistic. What remained was negotiation. Negotiation under deadline favors those without urgency. This reality exposed a deeper flaw in modern commodity finance. Markets had been priced as if silver were abundant and flexible. In truth, it had been stretched thin by years of financial layering. 1 ounce supporting many claims works only when delivery is optional. Delivery had become mandatory. For business leaders watching this unfold, the lesson was clear. Physical constraints override financial innovation. Models collapse when inputs cannot be sourced. Risk is not evenly distributed. It concentrates where reality resists adjustment. Silver was not becoming valuable because of speculation. It was becoming valuable because it could not be replaced. The physical market does not care about balance sheets. It responds only to availability, necessity, and time. These forces operate slowly, but once activated, they are difficult to reverse. Part 3 ends with a hard boundary. Finance has reached the edge of the physical world. No policy, no leverage, and no contract can move that boundary quickly. When markets collide with reality, adjustment does not happen smoothly. It happens through stress, and stress does not remain contained. In the next part, the consequences move outward, into credit, confidence, and strategic decisions that affect businesses far beyond the silver market itself. What began as a metals issue did not stay there. It never does. When physical limits collide with financial promises, the effects spread outward, into credit, confidence, and decision-making across the economy. Silver was only the trigger. The real story was how quickly trust began to thin. Banks operate on confidence before capital. Depositors trust institutions to return funds. Businesses trust banks to provide liquidity. Markets trust that contracts will settle as expected. When one part of that chain weakens, the strain moves fast. The ultimatum forced banks to prioritize survival over optimization. Risk was no longer something to manage gradually. It became something to reduce immediately. That change alters behavior. Credit tightens first. Banks facing uncertainty pull back. They review lending standards. They reduce exposure. They delay approvals. This does not require a crisis announcement. It happens quietly, one internal decision at a time. For businesses, the impact feels sudden, even when the cause is invisible. Entrepreneurs notice it as slower responses, stricter terms, and higher collateral demands. Established companies notice it as reduced flexibility and increased scrutiny. Capital becomes selective. This selectivity matters more than price. In stressed systems, access to capital becomes more important than its cost. Businesses that rely on continuous financing feel pressure quickly. Those with strong balance sheets and optionality gain advantage. The Silver Ultimatum highlighted another overlooked risk: counterparty exposure. Many assets exist only as claims on someone else's promise. When trust weakens, those claims lose strength. This is why physical control regained importance. Assets held directly behave differently from assets held through intermediaries. Ownership clarity matters when institutions face stress. This applies not only to metals, but to inventory, cash management, and supply contracts. Business leaders began asking different questions. Not just what is the return, but who holds this? And what happens if access is delayed? These questions are strategic, not reactive. History shows that major financial disruptions rarely spread evenly. They concentrate where leverage, dependency, and opacity intersect. Companies with high reliance on short-term funding or complex counterparties face higher risk. This moment rewarded simplicity, clear ownership, reduced leverage, flexible supply chains. These traits do not maximize profit in calm times, but they preserve options when systems tighten. The ultimatum made that trade-off visible. Another consequence was psychological. Markets run on expectation. When participants sense that rules are changing, behavior adjusts before outcomes are known. Precaution replaces confidence. This is why volatility increases even without immediate failure. The business community often waits for confirmation before acting. By the time confirmation arrives, options are limited. Structural warnings matter because they arrive early, when choices still exist. The Silver Deadline was such a warning. It signaled that governments were willing to force resolution rather than extend delay. It signaled that physical verification mattered again. It signaled that financial engineering had reached diminishing returns. For young entrepreneurs, the lesson was foundational. Growth strategies built entirely on leverage and speed perform well until conditions shift. Resilience comes from balance, not momentum alone. For established leaders, the lesson was strategic humility. Systems that appear stable can change quickly when assumptions are challenged. Preparedness is not pessimism, it is professionalism. The ultimatum also reframed opportunity. Periods of adjustment create winners as well as losses. Those positioned with liquidity, flexibility, and clear ownership can acquire assets, talent, and market share from weaker competitors. But this requires patience and discipline. Chasing price movements is not strategy. Understanding structure is. The silver market's stress revealed a broader truth about modern finance. Complexity hides fragility. Simplicity exposes strength. When deadlines force clarity, only the strongest structures hold. Part 4 ends with perspective, not prediction. No one can say exactly how this adjustment unfolds. What can be said is that the rules have changed. Time is no longer unlimited. Trust is no longer automatic. Physical reality has reasserted authority. For business leaders, this is not a reason for fear. It is a reason for awareness. Those who recognize structural shifts early can adapt calmly while others react under pressure. The 90-day ultimatum was not just about banks or silver, it was a signal that the era of endless rollover is ending and the era of verification has begun. Those who understand that difference will not just survive the transition, they will shape what comes next.